So we're going to continue with our next panel on the theme of economics and international research. So there are a couple things that I think we could take away even thus far today. One is that QE used to be called unconventional monetary policy, but I guess it's here to stay. So maybe our next panel can help us understand how that will evolve. So let me invite up Olivier Garnier first. He's the General Director of Economics and International Relations here at the Banque de France for some comments.
Okay, good morning to all of you. It's a pleasure to be here. So, to introduce this day, my idea was to give you a kind of broad, I would say, broad flashback on what has happened since the Great Financial Crisis. Because indeed, as you know, the Great Financial Crisis started about 10 years ago. And, now the question is, what has changed or not changed after the Great Financial Crisis? Because there is maybe a tendency to think that now we are completely in a new normal, that everything has changed. But as you know, there is a famous quote saying that when everything is changing, maybe nothing is changing. And what I would like to discuss with you is maybe what is really a break compared to what happened before, or what is in the continuity, because many trends that we see now maybe are in the prolongation of what we have seen before. And in this presentation, I will rather focus on the real economy, because indeed, we know that there have been also many changes. We just discussed now about fintechs in the financial sector. I will not discuss the financial sector. I will not really discuss also monetary policy, because I know that Dave will discuss that in his presentation. So I will rather focus on the real economy, starting with, I would say, long-term growth and productivity, then more the business cycle issues in terms of labor markets, inflation, and last but not least, debt and global imbalances. So starting with growth, I think, and if you look at this chart about the global trends, looking at world trade and industrial production, clearly a key change, possibly not related to the crisis per se, is the fact that what we have seen in the past recent years is a much slower increase in global trade, especially in terms of the elasticity of global trade vis-à-vis global growth. And we don't know yet whether or not it is, I would say, a temporary phenomenon or a lasting phenomenon related. Maybe we know that in the early 2000s there was a new wave of globalization, with, for instance, with China entering the global economy. Now maybe, there is a debate whether or not we are going forward in terms of globalization. Some people are talking about deglobalization. We see also some rise in terms of discussion about trade barriers, but clearly this is, in that case, there is a question mark. Looking also at GDP growth, what we see both among advanced and emerging market economies, clearly compared to the pace that we had just before the crisis, we see that growth is somewhat slower than before, but we know that maybe the pace that we had in emerging market economy, for instance, before the crisis at about 8% was not sustainable. Maybe what is more important, if you look also at the US vis-à-vis the euro area, what is striking on this chart, looking at real GDP per capita, maybe people are thinking that, there is a wide divergence between the US and the euro area. When you look at this chart, you see the only period of divergence has been in about 2011, 2012. And looking also on the green light, you see the green line, sorry, you see the ratio EA versus US, you see it has been fairly stable. Instead, there is this break just during the euro area crisis. But if not, even now, you see the trend is about the same. So there is no, in terms of gap between the US and the euro area. Of course, what has been lost in 2011, 2012 has not been recovered. But if not, you see the pace, and this is not very well known, the pace is not that difference, both after the crisis and before the crisis. Within the euro area, you see some trading places. You see that before the crisis, Germany was lagging behind the rest of the euro area, and now Germany is ahead. It has been the opposite for Spain, for instance. Spain, you see, was leading the pack before the crisis, and then there was a crisis in Spain, and now, of course, Spain is recovering. There is a country which is clearly, but there is no change in the trend, unfortunately. It is the case of Italy. You see that Italy has been underperforming before the crisis and has continued to underperform after the crisis. When you look at real GDP growth since the early 2000s in Italy, it has been close to, it has been very disappointing with no growth in Italy. And this is, of course, a concern, and it might explain also what we see currently in Italy. And taking also a very long-term view, you see, over more than 1 century of data. It's some work which has been done by economists at Banque de France. You see that in terms of productivity, again, there has been, of course, in the after-war period, a boom in productivity, but now we are still in this long-term trend decline in productivity. So in that case, I would say nothing has changed, unfortunately. Maybe, and we can hope that in the future, at some point of time, given what we see in terms of, we are talking again about digitalization before, maybe at some point of time we will see that in the data, but so far, unfortunately, there is this decline in the growth rate of productivity everywhere in the world, including, on this chart you don't have emerging market economies, but we see that also in emerging market economies. And looking at working age population, we know that everywhere in the world population are aging. So far, we have not seen yet a very significant break. Maybe you see in Germany, you see that population is rather flat. Some migration has also provided some offset, but we know that in the coming decades, we have to expect, of course, a slowing labor force growth and even a decline in many economies. And you see, even China, you see the population growth in China is slowing. You see that now maybe the labor force growth is growing at a higher pace in the US than in China. The US is rather so far an outlier in terms of in terms of working age population growth. But I would say the change in the trend maybe is expecting more in the future than now. And looking at the global economy, with the shares in global GDP, of course, what we see compared to the early 2000s is the rise of China, either looking at PPPs or looking at actual GDP weights, and a decline of other advanced economies, including the US and, of course, Europe. So this was for the, I would say, in terms of growth and productivity. Now turning to more business cycle issues in terms of unemployment rates. You see, the gap in that case was talking before about the convergence between the US and the euro area in terms of growth per capita. But in terms of unemployment, what you see, the only time where there was maybe some convergence was during at the peak of the crisis. Now the gap is as wide as before, so it's not a change, unfortunately, but there is a wide gap. Where we see some change is in terms of, especially in terms of participation rates. What is interesting to see, first, if you look, for instance, at men between 25 and 54, you see that in the US there has been a significant decline in this participation rate. When I say significant for this category, because it's not a very large in terms of percentage points, but for this category is significant. Now it's picking up. There is some uptick, as you see. But what is interesting is that you see also in the euro area a tendency, also a flattening in this participation rate. So it's a kind of global phenomenon. Where you see some divergence is when you look at people between 55 and 64, the seniors. You see that in the US the participation rate has been flattening, but it was much higher than in the euro area. Why? At the same time, and this is it's clearly a break in the euro area, you see a significant increase in the participation rate of senior people in the euro area. It's also, of course, related to the reforms which have been implemented in terms of pension system. The fact that people living longer, they have to work longer. The replacement rates in social security systems have declined, so people have to work more, including during the retirement period. And this is a significant change, and you see even in terms of employment rate, you see a greater convergence. In terms of inflation, when you look at this chart, you could say, and looking at the current period, at the end of the day, you are not sure that there has been a big change, even though you see that in the US, looking at the red curve, so this is not PCE. Loretta was saying before that the key target for the Fed is PCE. Just to compare with Europe, we have taken here the CPI. But what we see is that before the crisis, you see in the euro area, inflation was around 2%, and the CPI in the US was a little bit higher than 2%. Looking now, the US is around 2%, and the euro area is between 1 and 2. But you see, inflation, even before the crisis, was already rather low on historical standards. So maybe there is much less discontinuity than we could think. But of course, there had been the shocks with the two shocks, where we see that inflation has gotten very low during just after the crisis. And in terms of oil prices, there is also some change, because you see that at the beginning of the previous decade, oil prices were between $20 and $40 per barrel. Now, even after the decline which occurred in 2014, 2015, you see that oil prices are still, I would say, on average, above the levels that they had before 2005. So there is a debate whether or not there has been a lasting increase in the equilibrium price of oil prices, but clearly, there had been a windfall in the early 2000s, and so far we have not seen, and all the I would say all the estimates, most estimates of the equilibrium price of oil, I would say, are above $50 per barrel, even though nobody is expecting oil prices to get back above 100. On monetary policy, maybe going directly, and it has been much discussed by previously in the keynote speeches, but just to say, clearly here there is a break, and I guess that Dave will discuss it. You see that everywhere in the advanced economy, the size of the balance sheet of central banks has much expanded, and it is not expected that this size will decrease quickly. And the question is what will be in the new normal, what will be and there is no, I would say, clear answer so far, what will be the size of the balance sheet of central banks. And looking at long-term interest rates, what we see is that clearly long-term yields are much below the level that they had before the crisis. What we see also, what is interesting, is the gap between the US and Germany. For the 10-year yield, currently we are at a 30-year, I would say at a 30-year record in terms of the gap between the US, the 10-year US and Germany, which is very significant, despite the fact that US yields are very low. And a puzzle also, and which is more a question of continuity, I took here the example of France, but it's the cost of equity, because despite the fact that long-term yields and bank loans rates remain very low, you see that the cost of equity has not significantly declined. So of course we know that it's always difficult to calculate the cost of equity, but based on I would say the most models, you see that the cost of equity is still close to 10%, despite the fact that risk-free rates are close to zero. And this is a kind of puzzle and is a key change, and it might explain also some change that we see in the economy. And looking also at exchange rates, what we see is that there has been no, I would say, of course there's fluctuations in terms of exchange rate. The key, maybe a change so far, is the discrepancy between the one hand, the yield gap, and taking here, practitioners very often use the 2-year yield gap between the US and Germany to try to explain fluctuations in exchange rate. But what you see clearly right now, over the past recent period, there has been a divergence between the 2-year yield gap, which reflects expectations on future monetary policies, and the exchange rate, although we have seen in the most recent days and weeks maybe some adjustment in the US dollar, but this remains to be seen. And in terms of real effective exchange rates, what is interesting on this chart, looking since the beginning of 2000, and the average at the 100 level here is the average level over since 1994, is that looking at the US and the euro area, for the US dollar and the euro, you see there is no major, I would say, disequilibrium, and I would say the real effective exchange rate of both the US dollar and the euro area of the euro are not very far from their historical average. On the other hand, what you see is a very significant appreciation of the Chinese currency. It's not, I would say, it's not abnormal for an emerging market economy to see an appreciation of this of its real exchange rate. The question could be the pace, but you see that over the past recent years it has been flattening. And on the other hand, you see that the yen, which was maybe undervalued in the early 2000s, overvalued, sorry, now is rather appears undervalued. So I would say it's more in Asia that you see big difference compared to past trend. And to finish now, a few words about debt and global imbalances. In terms of debt, what we see is that private debt, non-financial private debt, has stabilized or even declined in the US and stabilized in the euro area for the private sector. But on the other hand, you see that this there has been an offset. This stabilization in private debt has been at the expense of the public debt, of the general government debt, which has continued to increase. And the consequence is that the total debt, has not declined. and that means that the total level of non-financial debt, private and public, is today significantly above the level that it had as a share of GDP compared to the early 2000s. So clearly there is a change. And when you look, and when you add to that, when you look not only at advanced economy but emerging market economies, a key change also, I have said just before, that after the crisis, the debt in advanced economies has rather stabilized, but there has been an increase in the debt of emerging market economies, especially corporate, for instance, corporate debt, and that means that you see even between 2007 and 2017, the total level of debt in the global economy has continued to increase by about 30 percentage points. In terms of global imbalances, global imbalances are still there, but what we see maybe is a change in the composition of the imbalances. I would say, in the mid-2000s, it was rather US, a large deficit in the US, a large surplus in China, and also with a surplus also among oil exporter countries. Now, there is also a surplus in the euro area. 10 years ago, the euro area was close to balance. Now the surplus has expanded, so there is a change, while the surplus of oil exporters has declined. So, there has been also an effect of oil prices on that, but clearly, you see now it's more US versus China and the euro area. And within the euro area, what we see also is clearly a change, is that now most euro area countries record a current account surplus, not only Germany or Netherlands, but including also the periphery country. France is rather an exception to the rule now in the euro area. And of course, on the one hand, Germany has increased its surplus vis-à-vis the rest of the world outside the euro area, while the adjustment in the periphery has also had an effect on the current account balance of the periphery, which was necessary because the external debt of these countries were very high. And to finish, a remark also on the corporate sector, because a key change, and in that case, it's not I would say it's clearly a break, is that, normally what we used to learn when we were students in economy is that the corporate sector was a borrower, a net borrower. What you see now, comparing the 2000 and 2016, you see that now in most countries, now the corporate sector is a net lender as opposed to a net borrower. A few countries, including France, are still, on the left-hand side of this chart, but this clearly is a key change. When you look also at a more global level, and you see that now corporate saving is much larger than household saving and is exceeding investment. And of course, this is related also to the fact that there has been a change in the labor share, with the labor share in most countries has been declining, and this helped to explain also the increase in corporate saving. But this change, we still have to see what could be the implication of this change, maybe at the same time, what we see also that the corporate sector is more involved maybe in terms of financial, instead of investing in fixed assets, investing in financial assets, doing some kind of financial intermediation, some kinds of, sometimes maybe some carry trade. So even in terms of financial stability, maybe we will have to look more closely at what happens within the balance sheet of the corporate sector. So just to conclude and to finish with this slide, maybe summarizing maybe the key challenges figures for the period ahead. You have here what I've called here the triangle of incompatibility with, on the one hand, an aging population, and at the same time, slower productivity growth and a higher public debt. Because if you have a higher public debt, but with less population growth and less productivity growth, of course, you have a problem. Initially, I would say and it is what we have seen before the crisis, the reaction to the top of the triangle was to increase debt to try to offset this decline in long-term growth. But now we have reached the limit of this process, and this was at the crisis. After the crisis, a solution has been to cut interest rates to make this debt more sustainable, but we know also that we have reached the limit of that. So now, I would say to get out of this triangle, I think what we have to do, and we have seen there is already some trend, of course, is to work longer to increase the participation rate of the population to offset the aging of the population, and of course, through innovation, through structural reforms, to increase productivity growth, and to try to this time to exit this triangle through other tools than through only fiscal and monetary policies. Thank you.
Okay, thank you very much. We're now going to move on to a talk by David Altig, who's the Executive Vice President and Director of Research at the Federal Reserve Bank of Atlanta. He has the role of advising the bank president on monetary policy, as well as managing the regional executives and the research department. Dr. Altig, please.
Well, thanks very much. It's always great to be here at the Banque de France, so I'd like to thank our host, as usual, for hosting us. So both the governor and President Mester made comments about the monetary policy framework. Noted that it involves a couple elements. One is, how big is the balance sheet going to be of the central banks all over the world when it's all said and done? What does that imply about the operating frameworks? What policy instruments will be at our disposal to conduct monetary policy? And importantly, what is the overarching framework in which we essentially operationalize our goals? What is the operational definition of price stability, for example? And that's where that part is what I'm really going to focus on in my remarks. Here's a table. It comes from an article in the Reserve Bank of New Zealand bulletin. And the only thing, and a bunch of central banks, and the only thing I mean you to see from this table is there's a bunch of twos. So basically, what is the inflation target across the world? 2% in one form or another. Some of it's formal, some of it's informal, various degrees of flexibility and ranges, but 2 is the number. So how did we get to 2? One possibility, it was an accident that came out of Australia and New Zealand way back when, combined with a lack of imagination by central bankers all over the world. So yeah, 2, that looks good. I think that it's probably useful to think of it as being more deliberate than that. So I have more words in this presentation than I ever put up. So I'm not sure I mean for you to read them, but they're kind of remind me of what I was going to talk about. This comes from then Governor Bernanke back in 2003. And the way to think about this is essentially most of the models we write down would tell you that the best inflation rate is actually deflation. This is basically the Friedman rule. It's still the case. This is a very robust property of many any monetary policy rules, and yet every central banker in the world would go screaming with their hair on fire if you saw a deflation. So clearly there was something missing. One of those things that was missing is that we believe the world is characterized by a bunch of frictions, wage and price rigidities in particular. That sort of moves you to a number more like zero inflation as being your target. But then there's this other issue, and again, writing back in 2003, of course, we weren't really contemplating what we subsequently saw in the United States and in Europe, but we were watching what happened in Japan, and there was a recognition that a country, a central bank, can find itself in the situation of having a configuration of the economy that had pushed policy rates basically to their lower bound, so we needed a little cushion. And at the time, basically 2003, when this was written, 2%, we were pretty sure 2% was a sufficient cushion to keep us away from the lower bound. We would run this thing through a lot of models, lots of simulations, and they would all tell us at the time that basically if you had 2% inflation sort of on average in the long run, you would probably not run into this lower bound problem very much. That was then. So I'm not going to really make this an indictment of those models. What we have subsequently learned as a consequence of the crisis and the economic environment afterwards are these words from President Mester. Look, the whole configuration of global interest rates has fallen. Maybe it's temporary, maybe it's permanent, we don't know, but essentially inflation-adjusted real interest rates are now lower, so with 2% inflation, the probability of hitting those lower bounds has increased, and increased substantially, and contemplating at least that this will be persistent situations that will arise periodically, if not permanent, maybe it's a good time to rethink sort of how we're operationalizing our definitions of price stability and what they mean and sort of what the long-run framework in which we operate strategically looks like. So we've already heard from the Governor and President Mester several of the kind of options that are on the table. I just want to say I've put down a bunch of names and associated a bunch of names with all of these ideas. I want to be clear, they're not the only ones who talked about these things. And I also want to be clear that none of them necessarily endorse these ideas. It's just that there's some speech where they talked about them. So this is not meant to imply that these are the proposals of anyone, but simply a set of proposals on the table. So what are they? We've already gone through several of them. One is just don't worry about it. Maintain the status quo. You heard, I think I heard this morning, a fair amount of satisfaction that the tools that we had at our disposal during the course of the crisis and the subsequent recovery have been sufficient to the task. So rather than mess around with kind of the bigger framework, just get used to the fact that we're going to have to use something other than policy rates now and again when the lower bound problem emerges. On the other hand, you have the Blanchard idea of raising the inflation target. You have nominal GDP targeting, which would automatically sort of adjust your effective inflation rate in the reverse way of changes in the long-run trend growth of GDP. Price level targeting and variations of price level targeting, which would basically invoke price level targeting at the zero bound. That's sort of a temporary measure. And then a more recent one that has been proposed by President Rosengren from the Boston Fed, that maybe we ought to basically just tell everyone, at any point in time, we're going to have inflation targets between 1% and 3%. It's going to be contingent on the state of the economy. Just get used to it. So here's the question. So all that's very familiar. Here's the question I want to pose. How might we decide across these alternatives? Which one would you pick, and by what criteria would you pick them? Well, here's a couple ones that I think are pretty obvious. Which of these alternatives are effective against the lower bound problem? And the one that we don't talk about very much, and that I in fact mostly want to talk about, is do the different alternatives equivalently satisfy some meaningful and generally agreed upon definition of price stability? Now that seems completely obvious, except that I don't know what our definition of price stability is exactly, except 2%. But even then, 2% is not so clear. Because do we mean 2% is just an aspirational level to which we will converge? Or do we mean literally 2% on average over some meaningful horizon? So these definitions that we've invoked typically about what we mean by price stability are not so obvious. Now you have this definition. So this is just from a quote from Rick Mishkin speaking at a Brookings Institution conference not very long ago on whether or not the Fed should rethink its 2% inflation target. And Mishkin invoked Greenspan, who said, look, here's price stability. First of all, it's whatever I say. But I'm going to say it a particular way. If I can look out in the world and nobody cares what I'm doing, then that's price stability. Price stability is a state of mind. Price stability is a state in which no one's thinking very hard about what the rate of inflation is going to be when they make real productive decisions about saving, investing, and on and on. Okay? Well, I'm going to follow up here by suggesting a somewhat more precise notion of that. So here's what I will argue are sufficient conditions for the Greenspan definition of price stability. Not necessary conditions. I mean, there might be lots of ways to get here. But I think these two things are sufficient. So if you save $1 today, you save €1 today, how confident can you be about the value of that dollar or euro at any horizon in the future? And in particular, can you be confident that the real value of the currency will be within some predetermined range that you can articulate today, again, at any time in the future? And is that range small enough to not distort real decisions materially? Real decisions about saving and investment and all that sort of stuff. Okay, so I'm going to say if those two conditions are satisfied, you have the Greenspan definition of price stability. So I'm going to then suggest here's a simple way to think about delivering those conditions. This is a price level target. So at this point, I want to make very clear. And by the way, so these things, my boss, Raphael Bostic, who's the president of the Atlanta Fed, wrote a series of blog posts about what I'm going to tell you here. We called this here the principle of bounded nominal uncertainty. I can't tell you for sure what's going to happen, but I can tell you within some range what's going to happen, and I'm committed to delivering it. So here's the picture worth 1,000 words. Here's what this frame would look like. I started this picture in 1995. that I'm really basically following St. Louis Fed President Jim Bullard here, who said, you know, and you'll see why he said it in a second, that effectively 2% inflation target took hold in the United States in about 1995. So the orange line there is just a 2% inflation path. The gray lines, that's just a bound of uncertainty. It's plus or minus 5% from that central line, that 2% growth path, at every point in time along this picture. And why I chose plus or minus 5% will also be clear in just a second. So here's what we basically have in mind. How about a framework where every Fed communication about what they're up to, every FOMC communication about where policy stands today and where it is likely to go is processed through this picture. What would that look like? Well, there's some history and a projection. So the green line is just the PCE price inflation path. So you can see why President Bullard said what he did. Up until 2012, you could not distinguish between what the Fed delivered and basically a 2% growth price level targeting path. Effectively, that's what the Fed delivered for a couple decades. Then we announced an inflation target and all fell to pieces after 2012. We think we know why, so that's fine. You can also now see why I chose plus or minus 5%. Where the price level stands today in the United States is basically 5% below that 2% inflation path. So, how would you talk about policy in such a picture? Well, first of all, if back in 1995 the FOMC had said, here's what we mean by bounded uncertainty, we mean we will promise you that at any point in time you will not be more than 5% away from the value of the currency that would have been implied by a 2% inflation path. Now, of course, I drew those lines, so it still looks like we did the job. So if you move the goalpost, you always score. That's the rule there. And I don't know whether or not that's a sensible bound, and I'll return to that in sort of a second. But how would you think about policy? So here's a question. Does this kind of framework that I am, again, not proposing, but just sort of throwing out there, does it accommodate actually monetary policy as in the framework that we conducted in today? And the answer is, yeah, well, if those were your bounds, the answer was yes, because, and it doesn't matter whether you've defined 2% inflation as an average over time or tending towards 2%. So the dotted 2% projection, you can imagine the committee saying, well, now look, we've undershot for a while, but, you know, we're not worried. We stayed within these uncertainty bounds that we promised you back in 1995. We're going to get back to 2% and let bygones be bygones and not worry about it too much. On the other hand, the committee said, no, what we really mean by 2% inflation is average over time. So gradually, what we're going to do is move the green line back up to the orange line. Now, that's a tricky proposition without any other form of communication. Because suppose that you wanted to get back to a 2% growth path over the same 6-year period that it took you to fall off of that path. That would imply roughly 2.7% inflation per year for the next 6 years. Not clear there's anything wrong with that at all, except how can you be sure that you will maintain an anchoring of expectations over that period of time with that sort of overshoot on the rate of inflation? Well, the idea would be here is that you can look at the picture and see that, what it is we're delivering. The committee could decide all sorts of things. They could decide bygones are bygones. As long as we're not outside of these bounds, we're okay. The committee could decide this is a little too close for comfort because any material negative shock would move us out of these bounds and we will have violated our rule. You could say we just want a little bit of a cushion, so we'll let inflation run at 2.2 for a little bit until we get a little safer within these bounds. Or the committee could say, no, we're going to not worry at all about what the rate of inflation is, and in particular, we're not going to worry at all about elevated rates of inflation till we get back to the orange line, and then we'll start thinking about it again. All of which is just sort of to say, under this sort of heightened, more clearly articulated view of price stability, it would not necessarily change anything about what policy is today in the United States. It would only change the way it was communicated in some ways. What about, well, here's some other things to note. So it's what I just said. Look, the whole idea of this notion of what I'm going to call bounded price level targeting. In President Bostic's blog post, he called it flexible price level targeting, but I think that probably wasn't the best choice of words because flexible price level targeting has actually been appropriated a long time ago by probably Bernanke, I guess, or Mishkin sometime way back to mean, well, we are literally going to stay on the orange line, but we're going to take our time, we're not going to do it in a day. This means something a bit different than that. You could permanently be off of the 2% price level line as long as you're within some predetermined bounds on the price level. So the notion of the idea is you provide a clearly articulated, transparent way to both measure and monitor performance against a very well-defined kind of objective. Second set of questions are, is this consistent in general with all these other proposals? So again, I started this off by saying so you got nominal GDP targeting, you got price level targeting in its strong form or its weaker forms where you only invoke it on occasion. You got the Rosengren idea. Is this framework that I've described consistent with these other frameworks? I've said it's consistent with the status quo up to this important caveat of not allowing the price level to drift out beyond certain bounds. That's largely true with respect to most of these other alternative frameworks as well. In other words, bounded price level targeting allows a wide range, potentially, of short-run and medium-run inflation targets, which are entirely state contingent. The one thing it doesn't allow, it does not allow a permanent change in the steady state rate of inflation. So the Blanchard idea is out, unless you want to completely start over again. You just say, okay, now we're not going back to 1990, forget it. We're just going to start over again. It's not consistent with nominal GDP targeting unless fluctuations in potential growth are stationary. I mean, let's see. It's maybe consistent with the Rosengren idea, but again, it's consistent with the Rosengren idea as long as you're not talking about permanent changes. You can't flip from permanently saying 1% to permanently saying 3%, because eventually, for any finite bound, you'll be outside of them. And violating those finite bounds is a violation of this particular definition of price stability. The point is, though, that the whole discussion is really in some ways revolving around how do we maintain maximum discretion to deal with changes in the state of the economy while maintaining confidence that we're pursuing some nominal outcomes that you can trust and don't have to worry about when you make your decisions. And the thing that I sort of like about, I'm calling this a framework, but really this is an envelope for a bunch of frameworks. The thing that I like about wrapping all of these proposals about alternative frameworks into this idea of like bounded nominal uncertainty is it places a discussion, in particular discussion about the future of monetary policy research, in a place where I think that we maybe have been lacking. What really is the degree of uncertainty that maximizes this trade-off between discretion and flexibility and the creation of uncertainty that materially is a material impediment to the functioning of the real economy? Those are things we don't know very much about, and even without this framework, at least talking about it, our hope is it focuses attention to that kind of question and that kind of trade-off as we think about these different frameworks to deal with a situation that's probably going to be with us for quite a while. So, thanks.
Thank you, David. We'll now have some time for questions if we want to have the panel take a seat up here. Again, please note the microphone in your chair, and also please do introduce yourself to our panel.
Hervé Lumion from the Banque de France. So my question is for Dave Altig. So actually, do your proposal of bounded price level targeting actually match the Greenspan definition? Because he had more in mind the general saver, and so in your definition there is a drift, whereas maybe the general household would not mind about zero inflation, and in the long run, given what he had in mind. And my second question, did you try to put your setup into macro models to compare it with the outcome of other strategies?
So, is this on? That's good. So the first question, is it consistent with the Greenspan definition? Because that was your first question? Yeah, I think it was. I mean, because Greenspan all along presumably had in mind drift in the price level. So the notion of it is it's not really the drift in prices that kills you. It's the uncertainty about the drift in prices that kills you. So, you know, if I know that I'm going to be, you know, look, I mean, it's the difference between risk and uncertainty in kind of the Knightian sense. If I know kind of the range of outcomes that are likely to arrive, then that can be appropriately priced and it can be put into contracts. The question is, you know, how big can you make those bounds and have an acceptable price? And did we put this in? No, we have not put this in macro models. In part because the model that you put it in has to have this element where, which is not in many of the models we use, it has to have this element where there is a cost to variance. In some sense, this is a plea to be thinking in exactly those terms. I guess the onus is on us to put it into models now, though.
David, Chris Whalen from GIC. When you think about the targets for inflation, how do you fit in the limitations that have been imposed on the financial sector, particularly banks, in terms of lending? There's clearly less leverage, more capital than we had before the crisis. And then going back to the governor's remarks about the recent report by the Banque de France about non-banks, they are more dependent on bank finance than ever. You know, in the 1990s, non-banks could raise their own funds in the U.S. They can't do that anymore unless they're very large and they issue term debt, but they can't issue pass-throughs. They can't access the short-term credit markets anymore. They have to go to a bank. So how do you get the inflation target that you want, given the constraints, the prudential constraints, and then, of course, in the background, you have the demographic issues as well?
So Olivier may have some thoughts about this. I take it as axiomatic that a central bank should be able to deliver the nominal outcome that it desires, independent of all of the real stuff in the economy. So the stuff you're talking about, I mean, that's real stuff. Sort of the lending behavior of banks, the performance of the financial markets, those generate real outcomes. Now, when we're uncertain about sort of what the mechanisms are that generate those real outcomes, of course, sort of thinking about how you calibrate your policy to deliver a rate of inflation becomes more difficult. But there's nothing special about whether it's productivity or whether it's kind of conditions in financial markets or whether it's population growth. They all present, in some sense, the same flavor of challenges.
Yeah, maybe just to, I fully agree with Dave, and I think it's, in any case, what you said does not prevent the central bank to achieve its target. But coming back to what you said at the beginning of your question, I'm not sure that we can say that, the non-banks and more generally the non-financial sector is more dependent from banks now than it was before. As I said in my presentation, for instance, looking at the corporate sector, what we see, indeed, the corporate sector globally now is less dependent upon external funding, being from banks or from non-banks. And so it's more a question for the functioning of the real economy. I'm not sure. It may imply some change in the transmission of monetary policy, and we have to think more about it. It may have also some implications, as I have suggested, in terms of financial stability, even in the monitoring of financial stability risks. But it doesn't imply, I would say, a change in the ability of the central bank to achieve its target.
David Burson, Nationwide Insurance. Dave, the different formats of inflation targeting developed in a time where inflation was low and perhaps modestly below the target. But what happens if we get an inflation pulse, particularly on the supply side, a repeat of the 70s, that takes us well above the band? What do these policies imply for how monetary policy would work once you've moved significantly above the band?
Well, it would mean exactly what it means if you, symmetrically to what if you move below the bands. You would be presumably obligated, a central bank that laid this out as their framework would be presumptively obligated to calibrate policy to getting back within the bands. Right now, what it would mean, starting from where we are today, is that a significant negative supply shock would just be of no concern whatsoever, because we're already at the lower bound. So, in current circumstances, it's all good. In part, the idea here is but who should believe you? And in part, the whole idea is to provide a believable way to say this is not of concern to us, because here's what is of concern to us, and here are the conditions we will accept, and here are the conditions we will not accept. And what we won't accept is being outside of those bounds.
Yeah, thank you. My question was complementary to the other ones, because a lot has been said on the tools the central banks have in their hands now to manage economic cycles and business cycles. But of course, what we saw in the last 10 years is that cycles are much more dependent on financial cycles and deleveraging adjustments, leverage adjustments. And as Olivier pointed out rightly, I mean, the level of indebtedness in the world increased largely in the last 10 years. And the size of the non-banks and the shadow banking has also increased. And the disintermediation share, financial disintermediation also increased. So, and there has been a lot being done on Basel III and bank regulations, but a little has been made on the regulation, prudential, macroprudential tools, trying to manage the next cycles, which could come from this non-bank financial sector, much less regulated. We do not have macro stress tests on these sectors, on non-bank actors. So how do you assess the central banks are now, what are in this new framework, the tools? I understand lower rates, asset purchase programs, but on the macro prudential side, there has been little which has been said. So could you comment on that a little bit more?
Yeah, clearly, there is a new challenge for macroprudential policies. We are talking a lot about macro policies, but we are still, I would say, at the beginning in terms of the experience that we have, and especially, as you said, what clearly there is the risk that the financial stability risk, which were before in the balance sheet of the banking sector, now are moving in what has been named shadow banking, or even, as I said, even outside for instance, in corporate balance sheet, because we see some possibility, both in advanced economies and emerging market economies, of mismatches in the balance sheet of the non-financial sector. As I said before, we see, for instance, in advanced economies, the corporate sector investing more into financial assets, and maybe to earn some carry, but so we don't have a clear view on that. In emerging market economies, in the past, the mismatch in terms of forex was in the banking sector. The risk was there. Now there is a risk of mismatches of forex mismatch in the balance sheet of the corporate sector, and so that means that in terms of macroprudential policies, with this development of non-bank finance, we have to develop new tools. As you know, in France, at the end of December, the Haut Conseil de la Stabilité Financière has announced measures targeting at putting some pressure on highly indebted corporates, but so far I would say the traditional macroprudential tools were primarily focused on bank credit, and we have to think of new tools to better take into account what you said in terms of the financial cycle.
Yeah, I mean, I guess the only thing I would add to that is, it is something to think about as we think about regulating the institutions that are actually in our portfolios. So, regulatory responses that, look, all regulatory responses encourage arbitrage, institutional arbitrage. It's important that we keep that in mind and take some care. If what we are concerned about is that there is a whole sector that intermediates outside of the control of regulators, whoever they might be, then, how we're driving people to those sectors ought to be a concern when we, a solution that removes our capacity to intervene is probably a solution we ought to think about twice.
Kathleen Stephenson, both BCG and GIC. Dave, could you comment on the implicit asymmetry of the policy, the inflation policy, the way you have the framework, and how much of a hindrance would that be to adopting such a framework?
So why do you say there's an implicit asymmetry?
Because it would be difficult to see central banks adopting, let's say, a 2.7% inflation rate if we would have to see the convergence back to that yellow.
Well, so I agree with that. So, several people have made this observation that if we are serious about defining the asymmetric inflation goal in the United States as implying over the longer run at least, we're averaging 2% inflation, that all of a sudden is a real challenge. And it's a real challenge because you do have to countenance a long string of above 2% inflation, and I would consider something up near 3% materially above 2%, while maintaining anchored expectations around the 2% you're shooting for. The subtext of what I was presenting is that you need a pretty credible communication device if you're going to pull that off. So one answer is you just don't try to pull it off, in that you find yourself de facto in a let bygones be bygones sort of environment. That ought to be a deliberate decision, is sort of what we're saying. And whether it's what I presented up there or some other device to maintain credibility, if we're going to average 2% inflation over time after some considerable undershoot or overshoot, then you're going to have to convince people that you have not changed kind of your objective. And I think that's a challenge. Usually price level targeting is not dismissed, but one of the arguments against it is it's hard to explain. Well, I'm going to keep throwing this picture up to try to convince people it's not hard. It's a picture. And it's very clear what's going on in the picture. You would have to commit to making that kind of picture a continuing communication device. And more than anything, I see it as a communication device. And the reason that I was sort of stressing that a whole bunch of these other ideas could be shoved within that device is to kind of stress that it's a way to try to articulate what you're after in a measurable way, so that if you feel the appropriate thing is to run the inflation rate high for a period of time, you can explicitly articulate what that period of time is by reference to the price level target. I think that would be a good thing.
I was struck by Paul Horn, international economist with the GIC. I was struck by the absence of any concern about a longer-term return to fear of deflation. When you look at the demographic trends, when you look at the productivity trends, I'm thinking in particular of total factor productivity, and the fact that you all have injected something like $15 trillion into the economy, are we free of concern about disinflation or deflation?
No, you make a right point. There is, I would say, maybe the debate is not the same, for instance, in Europe and in the U.S., because in the U.S. there is this debate about, what could be, whether or not they have to adjust the inflation target or the way it is communicated. In Europe, so far, the key challenge is still to achieve our target, and talking about changing the target when you do not meet the target, I would say it's very premature. And as has been said, for instance, by President Mester, there is still the risk, and Governor Villeroy also said that we could hit more frequently the lower bound, and that means that there is still this risk, as you said, of low inflation or even deflation, especially when population are aging, productivity growth is slower, so the real equilibrium interest rate is lower. Having said that, that doesn't mean that monetary policy is ineffective, and maybe you have to be more resolute to fight deflation, but that doesn't mean that you would have necessarily deflation in this kind of backdrop. You just need the right tools, and to be also rather preemptive.
Yeah, so the answer is yeah. I mean, we're saying that there's an asymmetric preferences about the FOMC's goal means that you're worried about disinflation, and in the same way you're worried about excessively high inflation. I think one of the lessons from the crisis, though, both in the United States and in Europe, is that central banks are still apparently pretty good at fighting outright inflation scare or deflation scares. It was whatever it takes. It was Bernanke's 2010 Jackson, whatever year it was, Jackson Hole, where we said, oh yeah, look here, we know this, we got this one. We'll just print money until the cows come home. That was QE2. That was basically the message of QE2, and it worked. And it worked in Europe as well to kind of step up and say, look, whatever this takes, we're not going to let this take hold. So one of the good lessons is that maybe we're not really good at fine-tuning inflation up from 1.5 to 2, but we seem pretty good about keeping the outright kind of falling through the floor problem from getting out of control. One more, is that one more?
Well, I'd like to express the uneasiness that I feel and I sense in others. There's not enough connection between this academic definition and what's happening in the real world of finance, what's happening to the economy. Either you make decisions and tell us what they are, or we make the decisions and tell you what they are, or at least define the circumstances where you switch from one to the other. Maybe I missed something here, but it seems to me that this is disconnected. There's a disconnect here that's not defined, or perhaps defined differently. And that got to be straightened out in some way.
The nature of the disconnect is what exactly?
Well, 2% is pretty arbitrary. Could be 1.7, could be 2.9, could be anything. And it leaves me with a sense of discomfort that ultimately it isn't based on the fact that the economy has gone up that much.
Well, I agree with you that, I completely agree with the statement you just made. What the difference between 1.7 and 2% is in some world, meaning the one we live in, completely immaterial. The problem is, central bank lays down a marker. Central banks live on credibility. Central banks live on people believing more or less they're going to deliver what they said they're going to deliver, and it's not arbitrary, and it's not it's not kind of pulled out of thin air completely. If you say this is our objective, then you have an obligation to meet the objective. So why do central banks, why do I think that, we at the Atlanta Fed, I'll put it that way, why do we care about, running inflation at 1.5 instead of 2? Because we said 2. And if we really mean we'll accept 1.5, then we should say we really mean we'll accept 1.5. I mean, that's just sort of the bottom line of it, precisely so that that disconnect doesn't happen.
I am not Don Rissmiller, but I am Michael Drury, the Chairman Emeritus of GIC. I'm announcing our break at 11 o'clock. We'd ask you to be back at 11:15 when Arnaud Marais and a very exciting speaker, Michael Drury, is going to be here. So I look forward to seeing you in 15 minutes. Thank you.